So that sort of development, I mean, think what that would do to us. Think what it would do to the oil price. Think what it would do to markets. Think what it would do to gold. These developments are very, very serious and very, very disruptive, and would probably override that schema that I gave of a market which is likely to more or less repeat the course of the 1929 to 1932
Welcome to Economy Express, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now, let's get into the details of our news.
Good evening. In today's financial headlines, Alasdair McLoud, a renowned market analyst, has made significant adjustments to his price predictions for gold and silver in 2024, citing serious concerns over a possible market downturn that could rival the historic crash of 1929. McLeod draws parallels between the current economic landscape and the catastrophic market decline of the early 1930s, warning that we may be on the brink of a similar crisis. He points to growing economic instability, heightened geopolitical tensions, and an alarming disconnect between bond yields and equity valuations as key factors that could lead to severe disruptions in global markets. Turning to silver, the metal saw a 1.2% rebound after 3 consecutive losing sessions, thanks to easing recession fears. Market stability has returned, with investors focusing on potential interest rate cuts from the Federal Reserve, which could be as deep as 100 basis points. This speculation has revived confidence, suggesting that a recession might be avoided, offering support for silver prices in the near term. However, McLeod warns of potential vulnerabilities in the market. The disconnect between bond yields and equity valuations is now more pronounced than ever, posing a significant risk of a market correction. Japanese financial institutions heavily invested in foreign bonds and equities could exacerbate this risk if the yen strengthens, leading to a reversal of the yen carry trade and further market disruptions.
Occur, and you're right, it's difficult really to assess the importance of those events until they play out. But I think by far the most important thing to understand in terms of market valuation is the disconnect between bond yields and equity indices. Usually what happens towards the end of a bull market in equities is that you find that economic conditions are such that interest rates have already started rising, bond yields have already started rising, a tension develops between the valuation of the equity markets and the bond markets, and it sort of pulls apart like that, and then suddenly it snaps. This is, I think, what we're seeing. If you chart the 10-year US Treasury yield, invert it and put it alongside the S&P, you will see that an inverted yield and an S&P generally correlate pretty tightly. There have been exceptions. The first big exception was the dot-com bubble, and in the years following that. The second big one was COVID, where with the suppression of interest rates to the zero bound, the yield on the 10-year US Treasury just collapsed down to less than 1%. The third one, which is the one we're in now, is the biggest disconnect in terms of valuation that we have seen in history. Now, it is closed a little bit with the yield on the 10-year US Treasury coming off a little bit, and at the same time, the S&P 500 itself coming off a little bit. So that gap has closed a little bit, but it is still the largest in history. We are now in the situation where having the S&P having continued to sort of climb while bond yields were climbing, that disparity is so great that the snap is now in place. It's just a question of what triggers it. And what has happened is that the institutions in Japan, in particular, over many years have sought higher yields abroad by investing in foreign bonds, particularly US Treasuries, and also some of the European bond markets as well. They have also invested quite a lot in US equities. So we have this situation where, with the outflows of capital accelerated by the carry trade, as individual institutions in the US and elsewhere would rush out and borrow yen in order to sell the yen to buy dollars and then invest the dollars in T-bills for a yield pickup, really, of about 5%, leveraged up so that your return on your underlying capital is probably 50% if you leverage it up 10 times. You can see how this thing was taken to excess. And this was why the yen rate against the dollar fell from around about 100 to about 161.5, which was the lowest level for the yen. The numbers are upside down, incidentally. You need to invert the chart. And then everybody got wind, if you like, that the Bank of Japan was going to change its policy and actually raise interest rates from 0.1% to 0.25%. Wow, what a shocker. But what it did was it triggered an avalanche of reversal of the carry trade, as suddenly there were huge losses on the capital side of the carry trade, particularly where people actually hadn't covered for the exchange risk. And at the same time, you were finding that the Japanese pension funds and insurance companies were making, I mean, they were facing quite big losses where they were going out into term debt. And so really what they were doing is they were trying to liquidate their foreign positions as the currency was recovering, because the currency was wiping out any profits that they had or making their bond losses even worse. So they were basically selling dollars, buying yen. And the selling,
particularly in the US. In response to a possible market crash, McLeod anticipates that the Federal Reserve will likely intervene with rate cuts and increased liquidity to stabilize the situation. He draws a comparison to the 1929 crash, where initial panic was followed by a brief period of recovery, only to be overshadowed by a more prolonged and devastating decline. Geopolitical tensions, especially in the Middle East, add another layer of concern. A potential conflict in the region could significantly impact global markets, driving up oil prices and increasing market instability. Amidst these uncertainties, McLeod suggests that gold could serve as a safe haven for investors, benefiting from the volatility.
Japanese institutions' interests came at a very difficult time for the US market, because it was about that time there was some disappointing earnings coming through from, the Magnificent Seven, the top tech companies. And so you had this combination, if you like, which was driving down equities. And it is a crisis. And I think it's very much akin to the crisis that we saw, well, our grandparents saw in 1929. You have the first leg, where there is the panic. The panic subsides, the authorities come in, and in late 1929, the Fed actually did pretty much what it would do today. It went into the market and bought US treasuries to keep interest rates down. It made reserves available for the commercial banks so that their balance sheets were fine. Now, we do that with QE today. It's quite simple. So they will do the same. They will have to panic and cut interest rates. My guess is after we've seen something like a 30 to 40% fall in the S&P, they will cut interest rates. I can see the meeting, emergency FOMC meeting today. When that happens, I think markets will steady. This is what happened from around about November 1929 and ran through to around about May to June in 1930. Then the market started its pernicious decline from having rallied about, regained about half the initial fall. You then had this long, pernicious decline down to a low level where the Dow fell, roughly lost 90% or 89% from the top by mid-1932. I won't describe the crises that came with it, like banks failing and all the rest of it. This is the sort of thing which, we can envisage being repeated today. But you can see that the structure of the market, of the bear market, is actually quite clear in advance. We can see this in advance. So to summarize, you've got the initial crash where everybody throws their toys out of the pram. We all get terribly worried. Banks start worrying about the value of the collateral they've got against loans, all that sort of stuff. The Fed comes in, has to rescue the situation. Calm is restored for a number of months, and then the real decline starts, and it's very pernicious. I mean, we can see that. You can envisage that. There are other factors now which I think could change the timing of everything. And to my mind, the most important thing is the way in which tensions are rising in the Middle East. This, I think, is extremely concerning. It looks to me, when you get countries like America, the UK, France, and so on, telling their citizens, get out of Lebanon, they don't do that because they think there might be some vague risk. They do it when they're pretty certain that war is approaching. And they've also sent, fleets to go and sort of support whoever they're supporting. I mean, let's face it, is Israel. And this is going to bring in Syria. Syria will be attacked, of that I have no doubt at all. I would expect Iran to be attacked probably after Iran has had some sort of response to the assassinations. I mean, the assassination of a Hamas leader in Tehran was really a very, very aggressive thing for Israel to do, though I understand she hasn't actually admitted to doing it. Israel will be fighting for her life and as a nation. And I think that having got to this sort of stage, I see very little alternative, but Iran will be drawn into this. And I'm told that Iran has already mined the Straits of Hormuz and can close them off like that, electronically. So that sort of development, I mean, think what that would do to us. Think what it would do to the oil price. Think what it would do to markets. Think what it would do to gold. These developments are very, very serious and very, very disruptive, and would probably override that schema that I gave of a market which is likely to more or less repeat the course of the 1929 to 1932 mega bear market.
And rising geopolitical risks. In contrast, McLeod remains skeptical about the long-term viability of cryptocurrencies, viewing them as speculative assets rather than stable alternatives to traditional money. He also raises alarms about the increasing control governments are exerting over media and technology, which he believes could stifle free speech and deepen societal divisions. As global markets navigate these turbulent waters, McLeod advises investors to exercise caution, seeking refuge in stable, time-tested assets like gold and silver to weather the potential storms ahead. That's the latest from the financial world. Stay tuned for more updates, and as always, invest wisely.